All right, we've all heard those three letters, right? GDP. It's the one number that gets thrown around constantly, the ultimate report card for the entire economy. But what does it actually mean for you, for your investments? That's what we're going to dig into.
But first, let's start with a kind of a provocative question here. What if this one giant number, the one all the experts point to as the ultimate sign of economic health,
What if it isn't really the one that matters most for your money? It's a bit of a puzzle, right? And stick with me, because the answer could totally change how you look at the financial news from here on out.
Okay, first up, decoding the big number. Let's pop the hood and see what this thing is actually made of. So what exactly is gross domestic product? Well, the easiest way to think about it is like a price tag for an entire country's output over a quarter or a year. It's the grand total of every single finished product and service, from a brand new truck right down to the coffee you bought this morning.
the biggest piece of this whole puzzle by far is C for consumption. This is us, you, me, everybody. It's all the stuff we buy every day. It is the engine of the economy, and it's the part that's most directly connected to how companies are doing. I mean, it's simple. When we're all out there buying more stuff, companies make more money, and their stocks tend to do better.
Next up, we've got I for investment. Now let's be super clear. This is not about you or me buying stocks. This is about businesses investing in themselves. Building a new factory, upgrading all their computers, developing new software. It's a huge tell for how confident businesses are feeling about the future.
Then we add in G for government. This one's pretty self-explanatory. It's all the money that government is spending on things like new roads and bridges, military budgets, public employee salaries, the whole shebang. It's another massive part of the economic machine.
And finally, we have NX, which stands for net exports. It's a simple formula, a country's exports minus its imports. Now, for a place like the United States, you'll often see this number as negative. That might sound bad, but don't panic. It just means we buy more stuff from other countries than we sell to them. It's actually totally normal for a big consumer-driven economy.
So you add all that up, C plus I plus G plus NX, and what do you get? You get a number that's so ridiculously big, it's almost hard to comprehend. We're talking tens of trillions of dollars. And that's exactly why the raw number itself isn't what investors really focus on. Which brings us to our second section, the growth rate story. Because you see, it's not the size of the economy that moves markets, it's the change, it's the motion.
Look at it this way. Saying the economy is worth trillions of dollars doesn't really tell you anything useful. But saying the economy grew by 2.1% last quarter, now that tells a story. That gives you direction, it gives you speed, it gives you momentum, and that is information you can actually use. And of course, when that percentage growth turns negative and stays there, well, that's when you start to hear everyone whispering the R word. Recession. A shrinking GDP is the classic warning flare that the economy is in trouble, and that usually brings tough, real-world consequences like unemployment. So, Section 3, Economy versus the Market. Now, you'd think, pretty logically, that a growing economy means a rising stock market, right? Well, not always. And this, my friends, is where things get really, really interesting. I mean, this is the central paradox of it all. If GDP is growing, it means people are buying stuff and companies are making money. So why on earth would the stock market sometimes go down on good economic news? It makes no sense. Or does it?
Let's start to unravel this mystery in Section 4, a look in the past. The answer to that entire paradox comes down to one simple concept: timing. The economy and the stock market are looking in two totally different directions.
Here is the absolute best way to think about this, and I want you to remember it. GDP is your car's rearview mirror. It gives you a perfect, crystal clear picture of the road you've already been on. The stock market, on the other hand, is the windshield. It's always forward-looking, trying to price in what the road ahead is going to look like 6 or 9 months from now.
Need a real-world example? Just think back to early 2020. The market looked through that windshield. It saw the pandemic coming, and it plunged more than 30% in what felt like a heartbeat. But when the official Q1 GDP report came out, it only showed a small dip. It wasn't until months later, in the Q2 report, that the data finally confirmed the economic catastrophe the market had already priced in. Windshield versus rearview mirror.
So you might be thinking, okay, if GDP is just old news, should I just ignore it? And that's a fair question, but the answer is no, absolutely not. You just have to learn how to use it like a savvy investor. And that's our next section, putting GDP to work.
For a smart investor, GDP is actually incredibly useful in two key strategic ways.
First, for getting a read on the broader business cycle. Are we in an expansion or a contraction? And second, it's an absolutely essential health check if you're ever thinking about investing overseas.
Understanding that business cycle helps with a strategy called sector rotation. See, different parts of the market do well at different times. When GDP trends show an economy is just starting to recover, you'll often see sectors like financials and technology take the lead. GDP helps you see that 30,000-foot view so you can anticipate these big shifts.
And as for investing in other countries, GDP is your first stop, period. Think about it. You could find the absolute best company in another country, but if that country's entire economy is shrinking, that company is swimming against a very strong current. It's just so much harder for it to succeed.
Okay, this brings us to the final piece of the puzzle, and honestly, this is probably the most important takeaway for any investor. Section 6, the element of surprise.
Remember this, the market doesn't move on good news or bad news. It moves on a surprise. You see, economists and analysts, they all have their forecasts, and the market has already baked those expectations into stock prices. The real event, the thing that actually moves your portfolio, is when the actual GDP number comes out and it's wildly different than what everybody thought it would be. So the next time a GDP report hits the headlines, I want you to ask yourself a different question. Don't just ask, is it good news or bad news? Ask yourself, was this expected? Are you just reacting to the same headline everyone else is reading? Or are you looking for that gap between expectation and reality? Because that gap, the surprise, that is what truly moves the markets.